Imagine if you can analyze a business as well as a professional investor. Believe it or not, but you can do that easily by mastering ratio analysis. In this video, I'm going to explain the 10 most important financial ratios to know, what they mean, and how to find and analyze them quickly. Hi, my name is Brian Feraldi. I'm a financial educator who's been analyzing and investing in businesses for more than 20 years. So ratio number 1 is used to analyze a company's balance sheet. This ratio is called the current ratio, and the formula is the company's current assets are in the numerator and the company's current liabilities are in the denominator. Now, this ratio helps us to figure out how easily a company can repay its short-term obligations. And an ideal range for this number is for it to be above 1.5. Now, to visualize this number, the numerator is the company's current assets, i.e. the most liquid assets that a company has, and the denominator is the company's current liabilities, which are all of the liabilities that need to be paid off in the last year. We want this number to be above 1.5, which would indicate it has 1.5 more current assets than it does current liabilities, and will have no problems paying its short-term bills. Now, there's no need to do this math yourself. We can use software like FinChat to look up all 10 of these ratios, and I'll show you how to do that using Microsoft as an example. So to find the company's current ratio, we simply scroll down to Ratios and then click Financial Health, and we can pull up the company's current ratio right there. We can see that Microsoft used to have a current ratio that was well above 2, and it's been trending down recently, and it's currently about 1.3. That brings us to balance sheet ratio number 2, which is the company's debt to equity ratio. The formula here is the company's total liabilities are in the numerator and the company's shareholders' equity is in the denominator. Now, this ratio tells us how a company is financed, and an ideal range for this number is for it to be below 1.0. So when thinking about the company's balance sheet, the numerator is the company's liabilities and the denominator is the company's shareholders' equity. We want this ratio to be below 1 because it would indicate that a company has more shareholders' equity than it does liabilities. Now, finding this number as FinChat is super easy because it's listed right here in the financial health section of the business. So in this case, Microsoft's debt to equity ratio is an extremely low 0.36, meaning it has far more shareholders' equity than it does debt. Key ratio number 3 is found by looking at a company's income statement. This ratio is called the company's gross margin. And the formula here is gross profit in the numerator and revenue in the denominator. This number shows how efficiently a company turns its revenue into gross profit, and an ideal range for this number varies greatly by industry, but we think a decent rule of thumb is for this number to be over 40%. So when visualizing a company's income statement, the numerator is a company's gross profit and the denominator is a company's revenue. Now, looking this number up in FinChat is extremely simple. For Microsoft, we just look right here under margins and we see that it has a gross margin of 69.7%. That is well over our 40% threshold. So Microsoft has an excellent gross margin. Ratio number 3 also looks at the company's income statement and it's called the company's net margin. The formula for this is the company's net income is in the numerator and the company's revenue is in the denominator. This ratio reveals how efficiently a company turns revenue into net income or profit. While this number will also vary greatly by industry, an ideal number for this range to hit would be above 10%. So when visualizing the income statement, the numerator here is a company's net income and the denominator is the company's revenue. Looking this number up in FinChat is extremely simple. We simply look in the margin section and we're specifically looking for the net number, meaning net income. In this case, Microsoft has a net margin of 36%, which is well above our 10% threshold and is a true sign of excellence. That brings us to ratio number 5, which is a ratio that's used to measure the company's capital efficiency. This ratio is called return on equity, and the formula here is net income divided by shareholders' equity. This number reveals how efficiently turns its equity into profits, and an ideal number for a company to reach is any number over 15%. So when visualizing a company's return on equity, the numerator here is the company's net income, which comes from the income statement, and the denominator here is the company's shareholders' equity, which comes from the balance sheet. Heading over to FinChat, we can see that the company's return on equity, or ROE, is listed right here. Now, Microsoft has a 5-year average return on equity of about 43%. But if we want to get the company's most recent return on equity, we simply scroll down and click on Ratios, and then Capital Efficiency, and then we look at Return on Equity. We can see in Microsoft case that the return on equity has jumped significantly over the last couple of years and currently clocks in at about 37%, a truly awesome number. That brings us to ratio number 6, which is a company's return on invested capital. This formula has the company's net operating profit after tax, or NOPAT, in the numerator, and the company's invested capital in the denominator. Now, this ratio also shows shows us how efficiently a company uses its total capital base to generate profits. And an ideal range for this number would be anything over 15%. So when visualizing these numbers on the company's financial statements, to find the company's NOPAT, or net operating profit after tax, we take a look at the company's operating income, and then we subtract out its income tax rate. So this would give us our operating profit after tax. That's the numerator. To find the company's denominator, we would have to use its invested capital, which is defined as a company's current assets minus any accounts payable and any accrued expenses minus any excess cash. Now that formula is fairly complex, which is why using software like FinChat to do this calculation for you makes so much sense. Now we can easily look up Microsoft's return on invested capital by looking right here. Its 5-year average return on invested capital is 28.7%, which is well above that 15% mark. If we want to get the company's most recent return on invested capital, we simply scroll down to the company's ratios and then capital efficiency, and we click on the company's return on invested capital. And we can get a sense of how Microsoft's return on invested capital has varied over time, currently coming in at about 24%. Ratio number 7 is used to gauge the shareholder's return on an investment. This ratio is called the dividend yield. Now the formula for this is the company's total dividend payments divided by its market capitalizations. You could also do dividend per share divided by the stock price per share. Now this ratio will tell us how much of the shareholder's return an investor can expect if they buy that stock solely from the company's dividend. And while dividend yields totally vary from industry to industry and company to company, ideally you'd want to see this number be somewhere over 2%. So when visualizing this, the numerator here would be the company's dividend payments, which you can find by looking at the company's cash flow statements. And the denominator here would be the company's market capitalization, which can be found by taking the company's current stock price and multiplying that by the number of shares outstanding. Now looking this number up in FinChat is incredibly simple. We simply look at the company's dividend section and we look at the yield. In this case, Microsoft has a dividend yield of 0.7%, meaning if we invested $100 into Microsoft stock, we could expect to receive 70 cents in dividend payments per year. Now, most investors are familiar with the dividend yield. However, there's numerous ways that companies can return capital to shareholders, including dividends, buybacks, and by repaying debt. That brings us to our 8th financial ratio, which is a company's shareholder yield. Now, shareholder yield is similar to a company's dividend yield, but in the numerator, we include the dividend payments, the net amount spent on buybacks, and the net amount spent on debt repayments. We take that total and we divide by the company's market capitalization. This ratio will tell us the total return that a shareholder can expect from buying that company's stock through all of the means that management can reward its shareholders. Now, the range here varies greatly from company to company, from industry to industry, but if you can find a shareholder yield over 3%, that generally speaking is a good sign. Now, thinking through this ratio when looking at the company's financial statements, when we look at the cash flow statement, we take into account all ways that company management teams can return capital to shareholders, and that includes repaying debt, repurchasing stock, and paying dividends. So that's in the numerator, and then in the denominator is the company's market capitalization, which is the company's current stock price times the number of shares outstanding. Now to find this number in FinChat, we simply scroll down, click on ratios, look at trailing valuations, and then click on shareholder yield. Then we can see how Microsoft's shareholder yield has changed over time, and it currently sits at 0.7%. That brings us to our 9th ratio, and this ratio is used to figure out a company's valuation. This ratio is called the price to earnings ratio, which is an extremely popular ratio that many investors are familiar with. Now, the formula to calculate a company's price to earnings ratio has the company's market capitalization in the numerator and the company's net income in the denominator. You could also do this exact same calculation by taking the company's share price in the numerator and taking the earnings per share in the denominator. Either way, this ratio tells us what the current market value of the business is per $1 in earnings per share. Now, price to earnings ratios vary wildly by company and can be influenced by a huge number of factors, but as a general statement, you want to find companies that are trading below 20 times earnings. Now, visualizing this when looking at the company's income statements, we would take the company's stock price, multiply that by the shares outstanding, which would give us the market capitalization, and we would divide that by the company's trailing net income, or the trailing earnings. This would give us the price to earnings ratio. Looking this number up in FinChat is extremely simple. Right in the valuation section, there is the company's PE ratio, and for Microsoft, this number is currently 35. We can also use FinChat to track how this number has changed over time by scrolling down, clicking on ratios, and then clicking on the price to earnings ratio. This will allow us to visualize how Microsoft's price to earnings ratio has changed over time. That brings us to our 10th and final ratio, which is also used to value businesses, the price to free cash flow flow ratio. Similarly, you could also calculate this by taking the company's price per share in the numerator and free cash flow per share in the denominator. Now, this will tell us the company's market value per $1 of free cash flow per share. And just like the price to earnings ratio, this number can vary greatly from business to business, but we want to see this number generally be below 20 for it to be a low value. Now, once again, visualizing this using the company's income statements, we take the company's current stock price, multiply by the number of shares outstanding, which gives us the market cap in the numerator, and then we take the company's free cash flow, which we can find by looking at the cash flow statement and starting with operating cash flow and then subtracting out the company's capital expenditures. This will give us the company's free cash flow in the denominator. Now, looking this number up in FinChat is extremely simple. Right on the main screen, we see that the P/FCF, which is price to free cash flow from Microsoft, is 42. But if we also scroll down and click on ratios, trailing valuation, and price to free cash flow ratio right there, we can also graph how this number has changed over time. So Microsoft's current price to free cash flow ratio of 42 is much higher than it has been historically and is well above our 20% threshold. So there you have 10 key financial ratios that professional investors use to judge the worthiness of a business for investment. Now, these are far from all of the ratios that are useful in analyzing businesses. There are lots of other ratios that different investors use when they are trying to analyze a company for investment purposes. For example, Warren Buffett has his own set of ratios that he uses to make investing decisions. Now, if you're interested in what ratios Warren Buffett likes to use the best, I made a simple PDF download that had all of Warren Buffett's financial ratios and rules of thumb on them. If you want a free copy of that PDF, just visit longtermmindset.co/Buffett or click the link in the video description and I will email you a free copy of Warren Buffett's favorite ratios. Well, thanks for watching. I hope you enjoyed this video. If you did, please give it the thumbs up. It really helps us out on YouTube. If you want to continue your education from here, I highly recommend you watch this video next.